Hey everyone, a very good morning to all of you guys. Good morning. So guys, let's start with the MCQs related to the finance current affairs. We'll be having a very short session today. The very first question for today is, regulatory authority periodically simplify the procedural requirements to reduce the compliance burden for the investors holding the physical securities. Under the revised framework of SEBI, Securities and Exchange Board of India, for the issuance of duplicate securities, up to what value of lost or damaged securities can the investor avail a simplified documentation process? So if you want duplicate securities without following the detailed procedure, documentation procedure, you can get that only if the value of the lost or damaged securities is up to 10 lakh rupees. Perfect. 10 lakh rupees is the correct answer here. Right? 10 lakh rupees is the correct choice here. Can be important for the examination. It was newly released on the SEBI's website. Right? Next one. Acha, tell me, which of the following document is required to be submitted for the issuance of duplicate securities when their value is within the prescribed simplified threshold? So the simplified threshold is up to 10 lakh rupees. So if the value of the security is up to 10 lakh rupees, then what will be the case? What documents will be required here? Court certified indemnity deed, police verification report, standardized affidavit, come the indemnity bond, public notice affidavit issued by the magistrate, or bank guaranteed indemnity certificate. And the correct choice here is standardized affidavit come indemnity bond. So that's what the simplification is. If the value of the security is up to 10 lakh rupee, it will be just done for you. The duplication work will be done for you if you follow the standardized affidavit come indemnity bond, right? Next one. For which value of security is notarization of the documents not required, allowing submission of a simple undertaking on a plain paper? Now, up to what value there is no requirement even of notarization. Now, that's the case of a very small value securities. That's the value of small. That's the case of small valued securities. If the value of the security is not exceeding rupees, everyone in the comment section, $50,000, no Bhakti, 50,000 is not the correct choice. So the correct option here is option B, up to 10,000 rupees. So if the value of security is just up to 10,000 rupee, then it won't even, you won't even have to follow the normal requirements, right? So you don't even have to get that checked by the notary public, as well as you need to just give an undertaking on a plain paper. 10,000, right? 10,000. Perfect. Next one. What was the year-on-year growth rate of India's index of industrial production in November 2025 that marked a 2-year high? This is the index of industrial production. The index of industrial production was 6.7%. Okay, 6.7% is the correct choice, option D. That is the November ka data. Next one. What is the name of the public infrastructure investment trust proposed by National Highway Authority of India that received the regulatory approval recently? Can be important. Anything related to infrastructure investment trust or real estate investment trust can be important for your examination. Okay. Option C, Rajmarg Infra Investment Trust, right? Perfect. This is the correct choice. Option C. Next one. The asset quality indicator are the key component of banking sector assessment. A sustained decline in the stressed asset reflects improved credit discipline for recovery mechanism as per the report on trend and progress of banking in India. For FY 2025, what was the approximate gross non-performing asset ratio of the banks? GNPA. We all know that we first calculate the gross non-performing asset ratio and then we deduct the provisions. Then we deduct the provisions and we get the net NPA number. What do you mean by NPA? Non-performing asset. Say for example, if a bank has given some loans and advances, that's an asset for a bank. Now if that asset is not performing well, we call it as a NPA. We call it as a NPA. The correct choice here will be 2.2%. Okay, 2.2% is the correct choice. Option D. Next one. Can you guys also tell me the return on equity as per the trend and progress assessment? Now what do you mean by return on equity? Return is on equity. So return divided by equity. By return we mean profit. Now what kind of profit we are going to take? We take earning available for equity shareholders. Now you guys will be only able to understand this terminology if you have done the ratio analysis, right? If you are very well aware about the flow of income as per the ratio analysis. So earning available for equity shareholders divided by average equity, or I can say equity shareholders fund, is nothing but return on equity. How much return you have generated for the owners of the company. The correct answer here will be option C, 13.5%. Okay, 13.5% is the correct choice. Option C, return on equity. Next one. By what amount did the net claims of non-resident on India decline during the reported period of financial year? A decline in the net claim. Here we are talking about the net claim. What do you mean by net claim? Non-residents do invest in India. Non-residents do invest in India. Now Indians are also investing in foreign countries. So what will be the net claim? What will be the net claim? Who has invested more? So the NRs, non-residents, have invested more in India by, as of now the number is 38.4 billion USD. 38.4 billion USD. By what amount did the net claims of the non-resident decline during the period? So there is a downfall by 38.4 billion USD. Next one. This is related to the bond market chapter. You can specifically link this question from your financial markets chapter, specifically bond market. How do bond yield generally move in relation to bond price? What is the relationship between bond yield and bond prices? Bond yield and bond prices. So recently we released a video related to the bond market. I request all of you to please do watch that video for the best understanding of the bond concept. The video name was RBI's big move, will the yield curve flatten in 2027? So there is an inverse relationship between the yield and the bond prices. When the yield goes up, the bond prices goes down, right? There is an inverse relationship, and this chapter can definitely be important for your examination as well, considering so many news around this chapter. So static part of this chapter as well as the dynamic part, both are important, and today we are going to understand the new concept after once we are done with the MCQs. Acha, before that, tell me what is the relationship between bond yields and overall market interest rate? Interest rate is also fluctuating in the market on a regular basis. What impact it will have on my yield? Will it have a direct relationship, or they are independent, or they are inversely related, or negative relationship? They are also inversely related. They are also inversely related. So today we are going to understand a new concept. We are done with the MCQs. Today we are going to understand a new concept, how the bond yield reacts as to the changes in the market interest rate. So when I talk about market interest rate, I mean whatever interest rate you are getting in the market as of now, right? And the market interest rate keeps on changing too frequently. At the same time, we are going to compare the bond prices with that of the interest rate. Now, if I talk about the bond prices and the interest rate, they do have an inverse relationship. What do you mean by inverse relationship? If the interest rates in the market starts going up, the bond prices will fall down, will go down for sure. Now, why it happens? Let's try to understand this one. Say for example, there is a bond of PT Limited. This is my company. We have a bond. I am the issuer of the bond, you are the buyer of the bond, right? So I am offering coupon rate of 10%, for example. The face value is 100 rupee. The face value is 100 rupee and the current market price of my bond is also 100 rupee. So can I say that net you will be earning 10%? If you buy the bond right now, you have to pay me 100 rupee. That's my current market price. On maturity, you will be getting 100 rupee. That is the face value. So face value and current market price both are same here in this particular case. And at the same time, you will be getting 10%. So let's suppose you invested for 1 year in my company. आपने 1 साल के लिए इन्वेस्ट किया तो आपको 10 रुपये मिलेंगे, राइट? 10 रुपये मिलेंगे, 100 रुपये की फेस वैल्यू पे 10% का कूपन. उसके अलावा और क्या मिलेगा? मेच्योरिटी पे आपका पूरा पैसा वापस मिल जाएगा 100 रुपीज. सो कैन आई से दैट वॉट एवर यू हैव अर्नड इज नथिंग बट 10 रुपीज. You have earned 10 rupees, right? So 10% is your return. 10% is your return. But let me take you through one more example. Let's suppose the market interest rate is now 12%. So you will be getting 12% in the market. But if you buy my bond, you will only get 10%. So will you be even buying my bond now? Will you be even buying my bond now? You won't be interested in my bond because my bond is just offering 10%, right? But in the market, you are getting 12%. In the market, you are getting 12%. Right? So now I have to pay you a premium so that you get compensated. So how can I pay you premium? I need to reduce my price. Will you guys buy my bond? Will you guys be buying my bond? No. So if the demand of my bond is going down, the market price of my bond will always go down, right? So मुझे मेरा प्राइस क्या करना पड़ेगा यहाँ पे? 100 रुपये से कम करना पड़ेगा. अभी जो मैं 100 रुपये चार्ज कर रहा हूँ आपसे, मुझे इस प्राइस को कम करना पड़ेगा क्योंकि ऑटोमेटिकली ये कम होने लग जाएगा. Why? Because there is no demand. Everybody wants to buy this 12% वाला bond. I am paying just 10%. So what I need to give you guys is a capital gain. For that I need to reduce my price. So let's suppose if I issue you this bond at 98 rupee, if my market price of the bond becomes 98 rupees, and if I pay you 100 rupees as the face value on maturity, can I say that 2 rupee will be your gain? 2 rupee will be your gain, right? So 10% you have earned as coupon rate, plus I am giving you 2 rupee additional gain as well. So somewhere or the other, you are at 12% or maybe at more than 12%. Now you guys will be interested in buying my bond. So can I conclude that if the market rate increases, nobody will be interested in buying my bond. Why? Because I'm just offering 10%, but in the market if you invest, you will be getting 12%. So because of that, the demand of my bond reduces, and whenever the demand of anything reduces, the price also reduces. That's the relationship between interest rate and bond prices. Now, here I have given you a question as well. Okay, do solve this. Right, just read this para later on. Just read this para, and that's why we say that the market prices and the interest rates are inversely proportional. Why they are inversely proportional? So my market price is 100 rupee. The interest rate in the market is just 10% only. That's fine. But the moment the interest rate increases to 12%, I have to reduce my price. I have to reduce my price from 100 to 98 or so on. Right? I'm not टॉकिंग अबाउट द एग्जैक्ट नंबर्स, यहाँ पे मैं राउंड ऑफ में बात करूंगा, पर अगर आप 98 करोगे तो आपका यील्ड 12% से भी बढ़ जाएगा. सो मुझे मेरा मार्केट प्राइस डिक्लाइन करना पड़ेगा, डिक्रीज करना पड़ेगा. रीजन बीइंग सब लोग 12% वाला बॉन्ड खरीदने में इंटरेस्टेड होंगे, 10% वाला कोई भी खरीदने में इंटरेस्टेड नहीं होगा. राइट? So guys, that's all from my end for today. Thank you so much for watching the session, and we have launched the RBI Grade B 2026 batch. This is with books. You can later on check out this course as well. Okay, thank you so much. Bye bye, take care. Very good morning to all of you. और बहुत ही strong start करते हैं morning का. सही है. Thank you so much.